B. Forecast/manage cash receipts and disbursements, cash flows, account funding. Cash flow forecasting is a critical treasury management function that ensures organizations maintain sufficient liquidity to meet operational and financial obligations. Treasury professionals analyze historical trends, operational activities, seasonal patterns, and anticipated transactions to estimate future cash inflows and outflows accurately. Forecasting supports decision-making related to borrowing, investing, and working capital optimization while reducing liquidity risk and unnecessary financing costs. Effective forecasts improve visibility into short-term and long-term funding requirements and allow Treasury teams to anticipate cash surpluses or shortages. Treasury professionals collaborate with departments such as accounting, sales, procurement, tax, and operations to gather timely financial information and improve forecast reliability and accuracy. Managing cash receipts involves accelerating collections, improving cash visibility, and ensuring funds are available when needed for operational activities. Treasury professionals monitor receivables, payment channels, lockbox arrangements, automated clearinghouse transactions, and electronic payment systems to optimize collection efficiency. Organizations seek to reduce collection float and shorten the cash conversion cycle to strengthen liquidity and reduce external financing requirements. Treasurers evaluate customer payment behavior, collection trends, and banking services to improve inflow timing and operational efficiency. Technology platforms such as treasury management systems and enterprise resource planning systems enhance real-time reporting, reconciliation, and forecasting capabilities, enabling treasury teams to make informed liquidity decisions based on accurate and timely cash receipt information. Managing cash disbursements focuses on controlling payment timing, maintaining account funding efficiency, and preserving liquidity without damaging supplier or creditor relationships. Treasury professionals oversee payment schedules, accounts payable processes, wire transfers, ACH payments, payroll funding, and check disbursements to ensure obligations are settled accurately and on time. Effective disbursement management requires balancing operational efficiency with liquidity preservation strategies. Treasury teams analyze payment terms, settlement cycles, and funding requirements to minimize idle cash balances and avoid overdrafts or liquidity shortages. Proper account funding also requires coordination between Treasury, accounting, and banking partners to maintain optimal balances across multiple accounts, subsidiaries, and geographic regions while supporting uninterrupted business operations. Accurate account funding is essential for maintaining operational continuity and supporting centralized liquidity management strategies. Treasury professionals use cash concentration systems, zero balance accounts, notional pooling structures, and intercompany transfers to allocate funds efficiently across organizational entities. Daily cash positioning activities help determine whether funds should be invested, borrowed, or transferred between accounts to maintain optimal liquidity levels. Treasury management systems provide visibility into global cash balances, transaction activity, and projected funding requirements, improving decision-making speed and accuracy. Strong internal controls, segregation of duties, bank reconciliations, and authorization procedures are necessary to reduce operational risk, prevent fraud, and ensure the integrity of cash forecasting and funding activities throughout the organization. From a CTP examination perspective, candidates must understand both the theoretical principles and practical applications of cash forecasting and account funding management. Exam questions frequently assess the ability to analyze cash flow scenarios, interpret liquidity trends, evaluate forecasting accuracy, and recommend funding strategies under varying business conditions. Candidates should understand forecasting methodologies, collection and disbursement systems, float management, liquidity analysis, and working capital impacts on cash flows. Treasury professionals must also recognize the importance of technology, banking relationships, and internal coordination in achieving accurate forecasts and efficient funding decisions. Mastery of these concepts supports effective liquidity management, financial stability, and strategic treasury performance.